For Chapter 10, we're looking at foreign currency exchange, and there's different levels that a company can be involved in the global marketplace. They can do a few transactions and require those transactions in their local currency like US dollar, therefore shifting the risk of foreign currency exchange to the other company. They can do some limited transactions where they convert, or if they're doing more transactions, they can actually hedge the risk of those transactions. In Chapter 11, we'll look at the highest level where you actually have a subsidiary in the foreign country. To start with, though, we're going to look at the simple example using what the text calls on page 556 the two-transaction method. Now, the text doesn't have a really good exercise or problem for this, so I'm just giving you an example here, and in your homework you're going to have a handout for it. So in this example, May 1st, the company sold inventory in euros. Well, obviously it has to be converted to dollars. And there's three important dates here. The date of the transaction, which is May 1st, a period ending date when we have to adjust, which is May 31st, and then the settlement date, which in this case is June 15th. So on the transaction date, we're going to record the sale and the resulting receivable based on the euros converted to dollars at the spot rate the day the transaction happens. So our sales is valued at 702. We know that whenever we have sales, we have cost of goods sold. So that one's easy. That we just record in the dollar cost that is already given. That takes care of our transaction. Now on May 31st, you'll notice just like the text did and talked about, I bolded the account that's subject to change. The sales amount is fixed based on the transaction. That doesn't change. But the receivables not yet been collected, and that value is subject to change. So we're going to change it by marking it to market, and we're going to adjust for the fact our currency changed value from May 1st to May 31st times the 520,000 euros that are part of this transaction. So as of May 31st, we've lost money on this transaction. And you can see from the spot rates here that we're going to, because unfortunately we're receiving euros, and the value continued to decline. So this would be an example of where the company, if they knew or anticipated the euro was going to be going down, would have hedged against this loss. Unfortunately, in this case, limited transaction, they end up losing a fair amount of money on the transaction simply because of the exchange risk. Now on settlement date, June 15th then, we record the 520,000 euros that are going to be received, and they can be exchanged for dollars on that day at a rate of 1.3, so they're going to get 676,000 in dollars. Well, at that point, the accounts receivable is now at a value of 686,400, meaning that there is another loss of 10,400. So unfortunately for this company, they lost $26,000 just based on exchange risk. And you could proof that number out if you want. You can look at the fact that the total exchange rate difference changed 0.05 times the number of euros, and there is our $26,000 loss between the two periods. Now under this method, this loss would have been recognized at the May 31st year end, so it crossed over two periods here. This would have been on the income statement for that year. This loss would have been on the income statement for the next year. So hopefully that will help you with your homework handout.